Investing in financial instruments in Kenya. Investing in financial instruments is a fundamental way to secure and grow personal wealth. And in Kenya, options such as Treasury Bills, also known as T-bills, Treasury Bonds, also known as T-bonds, and money market funds, also known as MMF, provide diverse avenues for portfolio diversification. Kenya is often cited as one of the fastest-growing economies in Africa. Over the past decade, it has experienced significant growth driven by various sectors, including agriculture, technology, manufacturing, and services. The rise of mobile technology and innovations such as M-Pesa have positioned Kenya as a leader in fintech. Key points: economic growth rates. Kenya's GDP growth has frequently been among the highest in the region, with projections often indicating continued robust growth, although this can vary year by year due to global economic conditions. Diversification. The economy has diversified beyond agriculture into sectors like tourism, construction, and information technology, contributing to its resilience. Investment climate. Kenya attracts foreign direct investment, also known as FDI, especially in tech and infrastructure, enhancing its growth potential. Regional hub. Nairobi serves as a regional financial and logistical hub, which supports business and trade across East Africa. The Nairobi Securities Exchange, also known as NSA, usually reports that foreign investors account for a notable portion of trading activity, often ranging from 30 to 40% of total trades. Understanding these investment choices is crucial to making informed decisions that align with your financial goals. Each of these options offers distinct features and advantages that cater to different risk appetites, investment horizons, and liquidity needs. Herein, we will explore each of these investment vehicles in detail while providing a comprehensive framework to help you navigate through the intricacies of investing in them in Kenya. Understanding the investment options. Treasury bills, also known as T-bills. T-bills are short-term government securities that are issued by the Central Bank of Kenya, also known as CBK, on behalf of the government. These securities have maturities of 91, 182, or 364 days, making them a popular choice for investors looking for quick returns on their investments. T-bills are sold at a discount. Investors purchase them for less than their face value, and at maturity, they receive the full face value. The difference between the purchase price and the face value is effectively the interest earned on the investment, which is attractive to those seeking safe and secure short-term investments. Treasury bonds, also known as T-bonds. Unlike T-bills, T-bonds are long-term securities with maturities ranging from 1 year up to 30 years. They provide semi-annual coupon payments, meaning that investors receive interest payments every 6 months until maturity, when they also receive the principal amount invested. This predictable income stream makes T-bonds suitable for long-term financial planning and can be an excellent choice for retirees or those looking for a stable cash flow over time. Money market funds, also known as MMF. MMF are pooled investment funds that typically invest in short-term debt instruments such as Treasury bills, commercial paper, and certificates of deposit. They offer investors high liquidity, as shares can often be bought or sold on any business day at the current net asset value. MMF generally yields higher returns compared to traditional savings accounts while maintaining low risk levels, making them an appealing option for investors seeking both growth and easy access to their capital. Step-by-step investment process. Treasury bills. Research and understand T-bills. Before investing in T-bills, it is essential to familiarize yourself with current interest rates offered at auctions and understand how bidding works. The auction schedules published by CBK detail when new T-bills will be available for purchase. Open a Central Bank of Kenya account, also known as CBK account. To participate in T-bill auctions, you must first open an investor account with the CBK. This can be done through their website or by visiting a branch office, where you will provide personal identification information, necessary for account setup. Participate in auctions. Once your account is established, check the CBK auction calendar regularly to find out when new T-bills are available. You can submit your bids online through the CBK platform or via an approved bank participating in the auction. Payment. If your bid is successful, you will need to transfer funds from your bank account into your CBK account to complete the purchase of your T-bills. Monitor investment. After purchasing T-bills, keep track of their performance by monitoring maturity dates and returns. Upon maturity, reinvesting your returns can help enhance your portfolio's growth potential. Treasury Bonds. Research and understand T-bonds. Similar to T-bills, researching current market trends and understanding how T-bonds function will help you identify suitable bonds that meet your investment objectives. Open a CBK account, if not already done. If you do not have a CBK account yet, follow the same registration process as outlined for T-bills. Submit applications. During bond issuance periods, apply directly through the CBK platform or by using a participating bank during designated application windows. Receive bonds. Upon successful application, your acquired bonds will be credited directly to your CBK account where they can be tracked and managed. Receive interest payments. Investors should keep track of their coupon payments, which are distributed semi-annually. Based on individual financial strategies, consider whether to reinvest these payments or withdraw them for immediate use. Money market funds. Research available money market funds. Investigating different money market funds is key to finding one that aligns with your investment goals. Consider factors like historical performance records, management fees, minimum investment requirements, and risk exposure. Choose a fund. Select a money market fund that fits your overall financial strategy based on its characteristics like liquidity provisions and expected returns relative to other options available in the market. Open an account with a fund manager. After selecting a fund manager who manages the chosen money market funds, complete all required documentation needed to open an account with them. Fund your account. Once your account is active, deposit funds into it, which will enable you to start investing in shares of the selected MMF promptly. Monitor performance. Regularly review the performance of your chosen money market funds against its benchmarks and other funds. This will help inform decisions about whether to reinvest dividends or make withdrawals as needed. Comparison of investment options. When considering investments in Treasury bills, bonds, or money market funds in Kenya, it is crucial to assess each option's risk profile, liquidity features, expected returns, and suitability based on your investment horizon. Risk assessment. T-bills. Considered low-risk investments due to government backing. T-bonds carry slightly more risk than T-bills because they involve longer maturities. Money market funds, generally regarded as low risk. However, performance can vary based on fund management strategies. Liquidity. T-bills offer limited liquidity. Funds are tied up until maturity. T-bonds, less liquid than T-bills. Selling before maturity might result in price fluctuations based on interest rate changes. Money market funds, highly liquid. Most allow withdrawals on demand without penalties. Returns. T-bills typically provide lower returns compared to other fixed income investments. T-bonds generally yield higher returns suitable for long-term investment plans. Money market funds usually offer competitive returns above traditional savings accounts, but fall short compared to longer-term bonds. Investment horizon. T-bills, best suited for short-term investments, less than 1 year. T-bonds, ideal for long-term investments spanning from 1 year up to 3 decades. Money market funds, flexible for both short-term needs as well as medium-term investment goals. Recommendations on best investment option when making decisions about where to invest among T-bills, T-bonds, and money market funds in Kenya. Investment goals. For individuals focused on short-term saving solutions or preservation of capital with low-risk appetite, T-bills or money market funds would be preferable. For those aiming for long-term growth while accepting moderate risks associated with longer maturities, T-bonds may prove more beneficial. Risk tolerance. Conservative investors often find comfort in low-risk options like T-bills or money market funds. Moderate risk takers may lean toward investing in T-bonds due to their higher return potential over extended periods. Liquidity needs. If having immediate access to funds is crucial, money market funds serve this purpose well due to their high liquidity provisions. Final recommendation. In weighing all factors, including security and liquidity considerations, money market funds emerge as a favorable option for most investors seeking quick access without compromising on returns. However, for those willing to commit capital over more extended periods with an eye toward higher yields, Treasury bonds represent another robust choice within this context. Conclusion. Navigating investments in Treasury bills, bonds, and money market funds in Kenya involves understanding each option's unique attributes while aligning them with personal financial objectives and risk tolerance levels. By following this detailed outline from initial research through monitoring ongoing performance, you can develop a tailored investment strategy that effectively meets both short and long-term financial goals while enhancing portfolio diversification amidst evolving market conditions in Kenya's dynamic economic landscape.